Stock markets continue up, bonds are mostly flat, rates remain unchanged, inflation is cooling, and the recession-avoiding soft landing appears to be happening so far. Also, the average investor's guesses about the direction of the market are as wrong as they are right over the last couple of decades. We'll cover that and more today. Welcome to the quarterly context for WealthStep webinar for the second quarter of 2024. WealthStep is an online financial guide to help people in 401k plans and other retirement plans, as well as individuals, make smart decisions about how much money they need to retire, how to save, and how to invest to get there. These webinars are designed to make economic and other information approachable, high-level perspective regarding the economy, markets, and investor behavior patterns to help you stay more relaxed by being more informed and make better decisions towards your goals. This presentation should be around 20 minutes, and recordings will be put on the WealthStep blog in the near future. Pass it on to people to help them achieve retirement readiness. Today we'll cover our traditional two parts. Section one is about perspective. Section two is about basic retirement planning ideas. As a reminder, there's also a video on WealthStep for a more expanded review of retirement planning concepts and education. And the key things that all of this ultimately is about is helping you aim, save, and invest towards being retirement ready. One of the key things to always keep in mind is to focus on the space between things you can control and things that matter. You can't control markets, you can't control inflation, you can't control a lot of things, but there are things that you can control, like your own decisions, your own behavioral choices regarding investing, and so forth. And so the key things are to save consistently, also something you can control, your life stage investment decisions, being diversified, and sticking with it through bumpy markets, especially if you are in the stock bond mix that's a fit for your life stage. Here we can see that there's always news every quarter, and while some quarters are bumpier than what's shown here, sometimes the news will cause markets to go up and down pretty significantly in the short run, but over the long run, it tends to smooth out despite what the short-term news is. Some key metrics recently regarding the overall economy, since this also has an effect on markets. The Federal Reserve Bank of the US rose rates 11 consecutive times between March of 22 and January of 2020. The largest, fastest sequence of hikes to try and rein in inflation, and that did turn out to be effective. Not quite as fast as some would have hoped, nor as fast as the Fed would have hoped, but inflation is now down to about 3% annualized versus the 9% annualized number in the middle of 2022. Inflation was actually slightly negative during the month of June. Stock markets were up around 3%, bonds just up slightly, so not bad result. Not as exciting as some other recent quarters, but things continue to move forward. Unemployment is hovering around the upper 3s to 4% still, and the projections of growth of the economy are cooling a little bit, which is part of what the Fed would like to see temporarily, so that to help bring inflation down, which will be helpful for consumers and the economy. Overall markets for the quarter, again, up about 3% for the US stock market, down a little bit for international stocks, but not by a lot. Emerging market stocks, less developed economies, up about 5% on average. Global real estate down a bit, and bonds roughly flat at just around 0.1%. If you look over the 1-year, 5-year, and 10-year numbers, almost all positive, and especially if you look out to 10 years, numbers look quite a bit stronger, especially in the US market, despite having gone through the COVID crunch and the interest rate cooling period, which had a negative impact on stocks and in particular on bonds, because when interest rates go down, when rates go up, bond prices go down, and that can lead to negative bond returns in the short run. If we look at the returns over multiple time periods, you can see the 10-year annualized numbers are strongest, are all positive and look like solid long-term returns, especially strong in large cap growth. These are mostly, or in not small part, large tech companies. The same is true for the returns since the market peak, the year-to-date returns, as well as the returns since the low of March 2020 in the worst part of COVID. One thing to remember, however, is that sometimes certain sections of the stock market are especially strong. That doesn't mean they will always be stronger. For example, small cap value was lagging quite a bit and has been making a bounce back. Small cap growth is weaker now over this period and will, over time, bounce back. Not that returns have been weak, but because the absolute returns, 100% return since March 2022 is still quite a strong return, but relative to the mega cap, very large cap growth companies, some of these other numbers look a little pale, but all in all, doing quite well. Just important not to over focus on those that are doing well recently, because markets are cyclical, and what's in favor will go out of favor, and what's out of favor will come back in favor, typically over time, over multiple cycles. Some are still wondering what the chances of going into a recession. The general consensus of economists is that the hoped for soft landing is happening so far, that the raising of rates, while having some slowdown effect on the economy, that's actually intentional to try and rein in inflation. That can slow the economy down to the point where it could be a recession, but so far the Federal Reserve seems to be slowing things down without triggering a recession. This doesn't mean that it's easy for everyone with the economy slowing, and it doesn't mean that inflation didn't exist and isn't still a problem for a lot of people, but it is helping stabilize markets and the economy for the benefit of the economy in the long run. Inflation has been cooling, as is the Fed's intent by raising rates. That improves overall economic stability and makes prices more affordable over time for people. And oil prices have been part of that cooling over time, bouncing a little bit back and forth over the last couple of years, but down from a high, pretty steep high in the middle of 2022. Interest rates. This chart shows the pattern of actual rates as set by the Federal Reserve Bank. Actual market rates vary, but this is the general pattern of how both the Fed and market rates have gone. And the projection is that rates will stay higher for longer until the Fed is really convinced that inflation is under control. And then it's projected that rates will come down. And when rates do come down, that will give bonds a boost and may also give stocks a boost, but the Fed is going to wait until they feel comfortable again that that won't trigger another bout. As a general reminder, right now with rates relatively high, it makes it more expensive to borrow, but it also means that cash in the form of money market funds and certain other kinds of vehicles are paying a relatively high interest rate. So if you have money in a savings account or a checking account, you're probably earning 0% or close to zero. And so if there's money that you don't need immediately, and it may make sense to look to find a place where you can have an account, some sort of brokerage firm or other location where you can purchase a money market fund, for example. Some people talk about CDs. Sometimes they return a little bit higher than money market funds, but have penalties if you withdraw early, and that sometimes leads the final return to be lower than what you would have had in a money market fund. So it depends on your situation and how certain you are that you can hold through the entire period of the CD. Now we'll take a peek at the general reminders for retirement planning, and here's the web address, wealthstep.com/blog, if you'd like to find a more complete video for a full discussion on retirement readiness preparation. We'll cover a few topics today, things that matter, how to avoid emotional investing, or the importance of not being an emotional investor, and so forth. So let's take a look. A couple of the key ideas is remain, aim, save, and invest. Aim is trying to figure out how much you might need in the future. A good place to start with that is to figure out how much you're spending now, how much you're able to save now, and whether or not you will have certain kinds of bills like a mortgage or other things paid off once you start retirement. If you begin to process that and write those things out, that will be a good first step towards figuring out what you might need per year. And then from there, that can help you figure out what you might need for the remainder of your retirement years if you stop working entirely. A general rule of thumb is to try to save 10 to 15%. That is oftentimes sufficient for people who start saving in their 20s or early 30s, but it depends on a number of things: how long you're likely to live, how much you plan to spend when you plan to start retirement. And if you are older than that, and have not saved at all or saved very little, it may be that you'll need to save more than 10 to 15%. But again, that depends on your goals and circumstances and what you plan and hope to do. Then the investment element should be the easiest if you have a 401k plan that is designed to have pre-built investment options like target date funds or target allocation funds that help you figure out how to invest by life stage so that you don't have to become an investment expert yourself. We'll show you an example of that in a moment. As a reminder as well, one of the things we see when we do investment education meetings is a pattern by age group. Oftentimes people in their 20s and early 30s will say, oh, I know this is important, but I'll save later. Life's a little bit expensive now and I'll have a lot of extra money. And retirement's a long ways away, so I'll deal with it later. And then people in their 40s say, oops, wait a minute. I said that in my 20s, but then I didn't start soon enough. And I'd really like to retire, maybe even retire a little bit early. And retirement isn't as far off. Maybe I'm halfway to retirement. I better start saving. Some people in their 50s and 60s wish they started saving sooner. And people in their 70s, if they didn't save enough, are oftentimes stuck working indefinitely, living paycheck to paycheck. So proper saving, the earlier you start, the more wisely you invest by life stage, the better off you will be. Here's a reminder of how the basic return and risk patterns are of different types of investments. So the top two are stocks, small cap stocks, small company stocks, large cap stocks, which are large company stocks. In the long run, you can see pretty bumpy, pretty volatile sometimes, but in the long run grow a lot faster over a long time period than bonds, for example. This is the growth of $1 over the last approximately 100 years versus $1 grown in stocks versus bonds versus cash, and what $1 then was the impact of inflation as well. So bonds are a lot less volatile and do have a place in the portfolio, especially as you get older and need to dampen the stock market volatility so that your money you're spending is not bouncing around so much. But the younger you are, the more sense it makes for the vast majority of people to take on a lot more stock market risk in order to have higher returns. Because if you don't do that, you can still get to the same place, but you'll have to save far more than if you save and invest wisely, understanding the volatility risks and understanding that trade-off. And remember that if you hold just in cash or cash equivalents, this is Treasury bills actually has a return. If you're holding it in your savings account, it's down here, it's essentially zero. And then you've lost $17 for every $1 to inflation. So it's an actual loss in purchasing power. So this is just a good visual image of the basic vehicles and the risk trade-offs in terms of some of that market fluctuation or volatility. In terms of investment vehicles, many retirement plans, including those that are using WealthStep, typically use what are called target date funds, where the stock bond mix automatically changes over time following something like this blue line over time, so that you don't have to do it yourself. It's done automatically, going through the different life stages as you go higher in age, and then it flattens out at a point where there's still some stocks, never 100% bonds, because you always want to combat inflation to keep your purchasing power into your later years. Another not quite as automatic, but also very effective and helpful tool are what are called target allocation funds. This is where you might have a 100% stock, 0% bond portfolio option, and that you could change into later into something like 75-25, 50-50, and 25-75, meaning at the end 25% bonds and 75%, sorry, it's 25% stocks, 75% bonds. And so different ways, in the target date fund scenario, you don't have to do that yourself. In the target allocation fund scenario, you have more control, but it means you have to decide when to ratchet down that risk as you go through time. Pre-built portfolios, you don't have to build them yourselves. You just need to make sure you're changing through the right stock bond mix to be reasonably appropriate for different life stages. Makes investing much simpler and easier over time. People who allow themselves to be reactive to stock market volatility, and naturally there's a certain amount of fear or concern that can happen when stock markets drop, but people who react to that and get out of the stock market and then miss the recovery end up with a lot lower return over time than people who are more disciplined and just stick with it during difficult times, knowing that it's bumpy and that bumpy is normal. So that's the difference between a discipline process, and this is oftentimes referred to as the behavior gap. And it's really a behavior cost, because people are costing themselves a lot of return just by trying to do the right thing, trying to take care of themselves, but are unknowingly harming their returns in the long run. Key message here is, if you're in the right stock bond mix for your life stage, best to just stick with it and adjust only generally as your life stage changes. WealthStep is going to have additional tools in the future, some online planning tools, as well as investment advice tools that are mostly about life stage orientation. There's the education video, which is already available if you go to the blog, and other information, help center, and frequently asked questions that are also available currently to educate you and guide you, including a financial planning service guide for those that need actual financial planning services. This guide helps you understand what questions to ask and how to find a conflict-free financial planning provider should you need that as well, and provide some resources about how to find one in your area that might be entirely unrelated to WealthStep. WealthStep has multiple options designed for 401k plans, designed for people who want the online tools and want portfolios managed for their money that's outside of retirement plans, for example, an IRA account or a taxable account. There's WealthStep Digital that'll be available just for the online advice without the portfolio management, and then a basic version for the public to help promote financial literacy and basic saving and planning decisions that are effective worldwide as part of our global financial literacy effort. So as a summary, aim, save, and invest. Use these basic guidelines that we talked about, and then customize to your own situation. And then spend, because spending is the reason you're aiming, saving, and investing. And then there are some key methods to help you spend in a reasonable amount so that you don't run out of money before you run out of years. And as a general reminder as well, you want to take on the right kinds of risks. Some of that volatility we talked about is helpful in terms of generating long-term return. Inflation is also a risk, and not investing subjects you to more inflation risk, and that can damage your returns in the long run. So thank you for being with us today. Share this information if you think there are others that might find it helpful, and we look forward to giving you another update next quarter.